Hello and welcome to our midweek Targets in Focus interview, where we pick a selection of currency pairs and ask a market professional to give us their predictions on a 1, 3 and 12-month period. Today, Eimear Daly from Monex Europe in London is going to take us through her so-called Quasi-Safe Havens, the Australian dollar against the US dollar, the US dollar against the Canadian dollar and sterling against the US dollar. Now, wage price data has affected the Aussie dollar of late, driving it lower. Eimear, talk us through your predictions on the Aussie against the US dollar.
Yeah, I know yesterday we saw a bit of a rally really in the Australian dollar off the back of the RBA minutes, as basically the market was pricing out kind of cuts to the interest rate. I do see that, we won't get another cut to the interest rate maybe until the second half, but I do think the Aussie dollar has really started this long crawl lower, and that the overall direction is down. The Australian dollar is really supported by what's going on in China and also commodity prices. But I think these two factors are really unsustainable. Australia has a mining investment boom, and that will peak. And when it does, the other sectors of the Australian economy aren't strong enough to really sustain the movements we've seen in the Aussie against the US dollar. So I'm seeing in maybe a year's time that we're actually back down at 96 cents.
The dollar CAD is another of your quasi-safe havens. It's reached a 7-month high recently, perhaps spurred on by Canadian wholesale data. What's your predictions for this pair and what's drawing you to Canada at the moment?
Well, I think what's going on in Canada is that it was so supported by all these diversification trades, that people were kind of selling out of the euro, selling out of kind of anything to do with the euro crisis, and really funneling back into Canadian securities. And actually yesterday we got data out that showed that people were actually net sellers of Canadian securities, and this is for the first time in years. So really the Canadian dollar is losing that kind of support. So I would definitely see the dollar CAD rising higher, maybe kind of in 3 months' time going to 104. I do think as well, we're not going to get a hike in interest rates anymore. We've seen that the housing boom is really in control. Housing prices are moderating, and also lower inflation rates will basically price out any kind of hikes to the interest rate in the near term.
Now, in stark contrast, sterling against the US dollar is almost at a 7-month low. The UK economy is still stagnating, although the labour force seems to be holding up reasonably well given the reductions in real income. You believe this pair to be a safe haven. Why? I think
it definitely was a quasi-safe haven, and with really strong performances in sterling against the euro. But now that the euro crisis has abated, we're beginning to look again at the fundamentals of the UK currency, and they aren't looking that good. We've really stretched government finance here, and we're dipping in and out of recession, and there's really nothing that's actually going to pull us out of this no-growth trap. Where is this? What Mark kindly referred to as escape velocity coming from. So I definitely think sterling will remain lower, and that we've really entered a lower trading range for the sterling dollar pair. I do think maybe in a year's time it will regain some kind of ground. It probably is oversold at these levels. Maybe in a year's time we'll be around the 159 level. But for the moment the direction definitely is down, and there's a lot of concern. I'll be very nervous to be long sterling at the moment.
Finally, Eimear, it might sound obvious to you maybe, but why should traders be attracted to these so-called quasi-safe havens right now?
Yeah, I definitely think, especially when we come up to the debt ceiling, which is really kind of going to undermine the power of the dollar as a safe haven. I think the interesting thing right now is that, quasi-safe havens really being sold out of because the euro crisis has in a way, lessened. There is some kind of improvement. So quasi-safe havens are really going to begin to sell off now, and we're really going to be forced to look at the actual fundamentals of the currency, and it mightn't be that good.
Thank you for joining me today and giving us your predictions. That's all for now. If you fancied something exotic, check out my colleague Jennifer Cordingley's interview on today's Bank of Thailand rate decision. I'll be back tomorrow with a look at manufacturing in Germany and France and how they compare. But until then, goodbye.